Are you confused about which ETF to invest in, VOO or QQQ? Let's make that decision easier for you. Welcome to this deep dive into two of the most popular exchange-traded funds, commonly known as ETFs, VOO and QQQ. These financial instruments bundle together stocks, providing investors an opportunity to diversify their holdings and reduce risk. Understanding the nuances of different ETFs is critical in tailoring an investment strategy that aligns with your financial goals. Over the course of this video, we'll dissect VOO and QQQ, examining their performance, risk factors, and potential returns. We'll also explore what a $10,000 investment in each of these ETFs could yield over various timeframes. So, whether you're a seasoned investor or just starting your financial journey, this comparison will be a valuable tool in your decision-making process. Stay tuned to understand the key differences between VOO and QQQ. First, let's discuss VOO, the Vanguard S&P 500 ETF. This exchange-traded fund, or ETF for short, is designed to track the S&P 500 index, which represents 500 of the largest U.S. companies. This means that when you invest in VOO, you're essentially investing in a small piece of all these companies. One of the key advantages of VOO is its lower expense ratio. At just 0.03%, it's one of the lowest in the industry. This means you get to keep more of your returns instead of paying them out in fees. VOO is also highly diversified. It spreads its holdings across various sectors, including technology, healthcare, and consumer goods, among others. This diversification helps to spread risk and can result in more stable returns over the long term. Some of the top holdings in VOO are household names, such as Apple, Microsoft, Amazon, and Berkshire Hathaway. When it comes to performance, VOO has a solid track record. It's posted a historical average annual return of around 10.7%. This means that if you had invested in VOO 10 years ago, your investment would have more than doubled by now. But that's not all. VOO also pays dividends. It has a dividend yield of 1.34% and a growth rate of 7.14%. This means that in addition to the potential for capital gains, you could also receive a steady stream of income from your investment. So who is VOO suitable for? Well, it's a great option for long-term investors who are looking for stability. Because it's tied to the S&P 500, VOO is less likely to have big swings in value compared to more specialized ETFs. This makes it a more stable option, especially for those who are just starting out in investing or who prefer a more conservative approach. In summary, VOO is a stable option with broad market exposure, suitable for long-term investors looking for stability. Now let's move on to QQQ, the Invesco QQQ Trust. Enter the world of QQQ, a powerhouse of a fund that tracks the NASDAQ 100 index. This index represents the largest non-financial companies listed on the NASDAQ, making it a hub for some of the most innovative and fast-growing companies out there. However, with great potential comes a slightly higher cost. The expense ratio for QQQ is 0.2%, a bit higher than its counterpart, VOO. While this might seem like a small difference, over time, it can add up, and it's something to consider when choosing between these two ETFs. Now let's talk about QQQ's sector focus. This fund is heavily concentrated in the technology and growth sectors. So if you're someone who believes in the future of tech and growth companies, QQQ might just be your ticket to ride. Its top holdings include household names like Microsoft, Apple, Nvidia, and Amazon. These companies are known for their innovation, and they've been behind some of the most significant technological advancements in recent years. Looking at historical performance, QQQ has a track record that might raise a few eyebrows. With an average annual return of 17.58%, it's outpaced many other funds, including VOO. But remember, past performance is not a guarantee of future results. And what about dividends? QQQ has a dividend yield of 0.55% with a growth rate of 9.93%. While its dividend yield might be lower than VOO's, its growth rate is higher. This means that while you might receive less in dividends initially, the amount you receive could grow faster over time. So where does this leave us? QQQ is a fund that offers the chance for significant growth. It's concentrated in sectors that are known for their innovation and potential. But with that potential comes a degree of risk. It's a higher risk, higher reward option, and it might be a good choice for those who are comfortable with taking on a bit more risk in pursuit of higher returns. QQQ is a higher risk, higher reward option, better suited for investors looking for significant growth potential. Let's compare the performance of VOO and QQQ. Diving right into it, VOO aims to track the S&P 500 index, which includes 500 of the largest US companies. This broad market exposure makes VOO a stable choice for long-term investors. Historically, VOO has offered a steady average annual return of 10.7%. This return rate, coupled with a low expense ratio of 0.03%, makes it a cost-efficient choice for those looking for consistent growth. On the other hand, QQQ focuses on the NASDAQ 100 index, which includes the largest non-financial companies listed on the NASDAQ. This concentration in technology and growth sectors has allowed QQQ to post a historical average annual return of 17.58%. However, this higher return comes with a higher expense ratio of 0.2% and potentially higher volatility due to its tech-heavy focus. Now let's consider how these ETFs perform under different market conditions. During bullish markets, when growth stocks tend to shine, QQQ has often outperformed VOO. This is due to its heavy concentration in high-growth tech stocks. However, in bearish markets or periods of economic uncertainty, VOO's wide diversification can provide more stability, often resulting in less drastic drops than QQQ. It's also worth noting the dividend yield of these ETFs. VOO offers a dividend yield of 1.34%, with a growth rate of 7.14%. QQQ, meanwhile, offers a lower dividend yield of 0.55%, but with a higher growth rate of 9.93%. In summary, VOO provides a more stable, diversified option with consistent returns, making it suitable for risk-averse long-term investors. QQQ, with its focus on the tech sector, offers higher potential returns, but also comes with a higher risk, making it more suitable for investors with a higher risk tolerance. While VOO offers steady growth, QQQ has the potential for much higher returns over the long term. What could a $10,000 investment in VOO or QQQ look like over time? Let's dive right into it. If you had invested $10,000 in VOO, which tracks the S&P 500 index a year ago, you'd have seen an average annual return of 10.7%. So after 1 year, your investment could have grown to approximately $10,700. Now, let's extrapolate that over a decade. With the power of compound interest at work, your $10,000 could potentially balloon to around $28,000. If you let it ride for 20 years, that amount could skyrocket to nearly $74,000. And after 30 years, you'd be looking at a nest egg of almost $200,000. Now let's turn our attention to QQQ, which tracks the NASDAQ 100 index. With an average annual return of 17.58%, your $10,000 could potentially grow to approximately $11,758 in just 1 year. Over 10 years, that $10,000 could grow to around $50,000. After 20 years, you might be sitting on a hefty sum of around $250,000. And after 30 years, your $10,000 could have morphed into a whopping $1,200,000. While these projections show the potential for both steady growth and significant returns, it's important to remember that past performance is not a guarantee of future results. Investment always carries risk, and it's crucial to consider your personal risk tolerance and investment goals when choosing where to put your money. Even if you don't have $10,000 up front, consistent monthly contributions can lead to substantial growth over time. Investing isn't just for the wealthy. Even modest monthly contributions can compound over time, potentially turning into a significant nest egg. So whether you're investing in VOO, QQQ, or any other ETF, consistency is key. Your future self will thank you for it. So which ETF is right for you, VOO or QQQ? As we've discussed, both have their unique attributes. VOO, with its lower expense ratio and broad market exposure, provides stability and is a go-to for long-term investors seeking steady growth. It tracks the S&P 500 index, showcasing the performance of 500 of the largest US companies. On the other hand, QQQ, with its focus on the NASDAQ 100 index, is a higher risk, higher reward option. It's concentrated in technology and growth sectors, catering to investors with an appetite for significant growth potential. We've also delved into the potential returns on a $10,000 investment in both ETFs, demonstrating that, while VOO offers consistent growth, QQQ has the potential for much higher returns over the long term due to its focus on high-growth tech stocks. At the end of the day, the best ETF for you depends on your investment goals and risk tolerance. Always do your own research and consider seeking advice from a financial advisor. Thank you for joining us today. If you found this comparison useful, don't hesitate to hit the subscribe button for more insightful investment advice. Sharing is caring, so feel free to pass this video on to friends or family members who might also benefit from understanding the differences between VOO and QQQ. We're here to support your investment journey with clear, actionable information. Remember, investing is a journey. Make informed decisions and you'll be well on your way to financial success. Before we wrap up, we'd love to hear from you. What are your thoughts on VOO and QQQ? Have you invested in either, or are you considering doing so? Your insights and experiences can help others in their investment journeys, just as we hope our videos help you. So, don't forget to leave a comment below. And if you found this video helpful, give it a like to let us know. Your support really does make a difference, and remember, subscribing to our channel is just a click away, and it ensures you won't miss out on any of our future investment advice. We're all on this journey together, so let's make the most of it. We'll see you in the comments.